Ever wondered about that mysterious space between the closing price of one trading day and the opening price of the next? That's a stock gap, a fascinating phenomenon that can either spell opportunity or caution for the keen-eyed trader. Today, we look into the intriguing world of stock gaps, exploring the four main types, providing examples, and offering some analysis. Our first stop is the common gap. This type of gap is the everyday run-of-the-mill variety that you'll see regularly in the stock market. It's typically small and occurs during trading sessions when there isn't much happening in the way of news or events that could significantly impact the stock's price. For example, if a stock closes at $50 on Monday and opens at $52 on Tuesday, that $2 difference is a common gap. Common gaps are often filled quickly, meaning the price moves back to its original pre-gap level. Next, let's shift gears to breakaway gaps. These are exciting because they often mark the beginning of a new trend. Breakaway gaps occur when the price breaks away from a well-established trading range or technical pattern. For instance, if a stock has been trading between $25 and $30 for several weeks, but then it opens at $35 with no return to the previous range, that's a breakaway gap. These gaps are typically accompanied by high trading volumes and can indicate the start of a significant price move. Our third type of gap is the runaway or continuation gap. This gap occurs in the middle of a price trend and typically signals that the trend will continue. For instance, in a strong uptrend, a stock might close at $100 one day and open at $105 the next, creating a gap. This is a sign that the uptrend is likely to continue. Runaway gaps, like breakaway gaps, are often accompanied by high trading volumes. Finally, we have the exhaustion gap. This gap occurs at the end of a price trend and signals that the trend is about to reverse. For example, if a stock has been in a strong uptrend, closing higher and higher each day, and then one day it gaps up significantly but closes the day lower, this could be an exhaustion gap. It's a sign that the trend has exhausted itself and a reversal may be on the horizon. So, to summarize, common gaps are small and often insignificant. Breakaway gaps signal the start of a new trend. Runaway gaps indicate the continuation of a trend. And exhaustion gaps suggest a trend is nearing its end. Understanding these gaps and how to interpret them can be a powerful tool in a trader's arsenal, offering insights into potential opportunities and hazards in the market. Remember, though, that while gaps can provide valuable clues about market trends, they are just one piece of the puzzle. Always consider other factors and indicators when making your trading decisions. The market is a complex beast, and understanding it requires a multifaceted approach. So the next time you're scanning the charts, pay close attention to those gaps. They might just be the key to unlocking your next big trading opportunity. Until then, keep those charts open and those minds sharp. Until next time, keep trading smart.